how do you look at India from growth, inflation, interest rates, and macro perspective?
We are at a very interesting juncture. Growth has been surprising on the upside for India. Inflation has been really very well contained.
We clearly seem to be in a surplus liquidity zone.
RBI is very mindful. They are not falling behind.
The fund has been really consistent in performance. How are you able to do this consistently?
Spread is one thing that remains a central part. So average maturity plays a big part of it. But it's not just the average maturity.
Hi everyone, welcome to the 10th episode of Fundamentals. Categorical decision making is the winning ingredient of this fund manager. Yes, I'm talking about Mr. Amit Somani, who manages Tata Money Market Fund. This fund endeavors to clock stable positive returns every month, yet endeavors to maximize returns every month. It maintains a great balance between creating alpha and arresting downside risk. Here we meet Mr. Amit Somani. Hi Amit.
Hi Shaily.
Glad to have you here and talking about the shortened space of the debt canvas. So broadly, how do you look at India from growth, inflation, interest rates and macro perspective in the background of the world? How has the regime change happened and historically, and what regime do you expect going ahead?
So we are at a very interesting juncture as far as growth, inflation dynamic is concerned. In terms of the Trump tariffs and so on and so forth, the growth has been surprising on the upside for India, and inflation has been really very well contained. I would say more than well contained. It's less than a percent or so. Going forward again, we feel that inflation will continue to remain benign. FY26 target for inflation has been revised downwards over last 7 consecutive policies, RBI policy, and currently we are talking about inflation heading much lower than 4%, which was the center point. On a growth front, again, surprising on upside. We have had a huge kicker. We have had a support coming in from government in terms of first infrastructure push, and then subsequently as the tariff started hitting us, we took a very sound measure in terms of cutting. So the rationalization of GST rate kind of gave another leg to growth. GDP growth has beaten Q2 and even Q3. It is likely to remain solid. For FY26, we now see GDP growth at close to 7 quarter or so, with the momentum still keeping on. Government continues to remain on path to kind of address growth. Monetary policy has also started participating with the recent 25 basis point cut coming in. So government has been trying to support it. In terms of macro stability, I think most of the parameters are in place except the rupee. So rupee continues to remain a hangover for the parameters. That's the only parameter right now, which is something that you really need to closely monitor at. And I think RBI is on it right now. We have had a lot of measures coming in from RBI. Apart from that, RBI is also ensuring that adequate amount of liquidity is there in the system to support growth, right? So there was a fillip coming in from government, GST rationalization, festive demand, and now RBI also coming in to actually give its support in terms of whatever it can for growth. With obviously inflation now continue to remain benign over next 1-2 quarters or so, I think RBI can step up this support, and thus we expect that RBI will continue to provide durable liquidity to the market in order to ensure that the growth doesn't slow down. So I think India is positioned very well in terms of it's kind of a Goldilocks moment for India, and it's very well positioned as far as growth is concerned, inflation concerned, and it's some bit of rupee that's what we want to get it right.
So one piece is the growth inflation dynamics, the other is liquidity, like you also mentioned in your response, and the other is then demand supply of securities issuances, demand from the mutual funds and other participants. So what impacts this space of money market funds? It's very important to know this before we move on to the fund and a few more parameters in detail.
Sure. So as you provided, some insights already that demand supply. So demand is basically coming in from mutual funds, for banks, from market participants, including insurance companies, and so on and so forth. In terms of, and specifically now we are talking about money market instruments. So these are the demand side of it, along with banks. And the supply is typically, the money market instruments we are talking about. So certificate of deposits, commercial papers, essentially banks and corporates who have access to wholesale market. They are the supply side of it. And the third is obviously the sovereign, which is treasury bills and government securities kind of paper. So this remain a key in this entire variable of how the rate moves, right? Apart from where the rates are headed in terms of policy rates are headed. Currently, we had this expectation of a rate cut cycle. It has played out over last one year or so. Going forward, I think it is more to do with now demand supply and how one anticipate the rate in light of demand supply rather than the policy, because policy rates are already at the bottom kind of a thing. Or almost like near the bottom.
So on demand supply, like we read and hear that the demand for securities in the longer end of the yield curve has relatively come down because of few regulation changes, and that's why demand from let's say insurance companies and EPFO has come down. Similarly, do you have any specific changes do you see that has come in the short end of the yield curve on demand supply?
So there is a indirect loop, if I may say. So when the demand for longer end comes down, it is taking the yield up. And generally there are market participants who can always fund those positions by kind of issue money market instruments, right? And that's how that also creates supply in the short end. And that's how this long-term rates going up sometimes can have their influence on a shorter term rates also. There seems to be some kind of interaction right now. So for example, when we saw longer term yields going up, we started seeing more of the supply started concentrating at a lower end of a yield curve, which created more supply that was, and which created kind of rates moving higher.
So Amit, moving on to liquidity, how do you think RBI thinks about liquidity or manages liquidity in the background of the need for currency intervention, as you also managed about the rupee, in your macro update? So how do you think RBI thinks in the background of currency intervention? And sometimes there are very stark movements in the bond yields where they could come in. So, and liquidity is is impacted by any of these actions. So how does RBI manage?
So if we want to simplify this,
Yes.
Currently RBI is enabled to kind of go behind the growth, right? So it is driving the liquidity, or it is driving everything in a way that supports growth, given that inflation is benign, right? Now in that perspective, RBI has mentioned that they will continue to keep sufficient liquidity. Now, how do they define sufficient liquidity? It's 1% of NDTL. All right. So, what is NDTL? Is net demand and time liabilities. So, 1% of that comes to something like 2.5 trillion rupee or so right now. Okay, which is close to 2.5 lakh crores. Now, RBI wants to ensure that banking system is always cushioned with this 2.5 lakh crores worth of liquidity, and so this liquidity can be used in order to promote, let's say, credit, which in turn helps GDP, right? Growth, the potential to fill the gap between the potential GDP and where we are right now. Now there are two parts to this liquidity. One, there is a seasonal kind of liquidity which keeps impacting, through this tax outflows or let's say GST outflows that happens every month. If you add banking system liquidity and government balances, there is something called we can arrive at core liquidity.
Yes.
So RBI wants to ensure how much is banking system liquidity, which I said is they want it to be close to 1% of NDTL.
Of NDTL, yes.
And how much does a core liquidity number should be, right? And I think my sense of that number is that it should be closer to 1 to 2% if we include both of these numbers. RBI is doing its action in such a way that this core liquidity number is maintained between 1 and 2%, and banking system liquidity is maintained close to 1%.
Okay.
Now, obviously, there are frictional reasons as to why this liquidity can go up or down. RBI uses short-term instruments if it feels that that is more appropriate at times, which is like repo and reverse repo windows in order to cushion those liquidity. Currently, RBI is using OMO and forex swaps to ensure that liquidity in the banking system remains adequate. The only the counter thought to this liquidity measure is if the rupee is kind of depreciating the way it is, it does confuses the situation, right? Because if you want to control the rupee depreciation, then you want tighten liquidity. But here, I think RBI is trying to arrive at a fine balance in terms of where it wants to see rupee, right? In terms of how it wants the rupee to kind of determine its path without managing any level on rupee. And at the same time, it also ensures that growth is not hampered, right? Which means generating banking system liquidity through durable means. We saw that a lot of measures were announced post last policy. We already had 1 lakh crores of OMO being announced in the month of December, along with $5 billion forex swaps. Being the month of December, the demand for liquidity was also high. We had a huge advanced tax outflows. We have a huge GST number. Currency in circulation again starts picking up from December onwards, right, going into the month of March.
So having covered demand supply a little in detail, having understood the liquidity perspective from you, moving on to how does RBI think about rate cut decisions? Because like you also mentioned, we had a good real GDP growth number which came in, but the inflation number was like low. It was a deflator. So the nominal GDP growth was lower. So in that background, how does rate cut decision happen?
Given that fiscal continues to remain well groomed with a fiscal deficit target of 4.4%, and we remain well on track to achieve that, monetary policy has levers right now to go and kind of support growth, and that's where I think RBI is on a rate cut cycle. We have seen a decent amount of rate cut. I think going forward, what we want to see is not rate cuts, but how we deal with the current situation in terms of liquidity, how much of support, how much of supply that gets absorbed by, let's say, RBI, and that creates overall environment for conducive yield curve, I would say.
So moving on to the fund now. With this understanding, money market space and money market funds are allowed to invest only in money market instruments and up to 1 year maturity. How do you want investors to look at this space?
Yeah. So money market fund, as you correctly said, can invest only in money market instruments. Now this has lower volatility because all of these instruments have to be less than 1 year at issuance. Right? It is not about average maturity, so you can have a 3-month instrument and a 2-year instrument and club them to get average maturity of, let's say, close to 1 year or so. It's that each and every instrument needs to be a money market instrument and money market fund. Right? Now, so how does it protect the investor? It reduces the volatility in the fund, right? So typically when we have volatile season, for example, volatile sessions, or let's say a seed of volatility, like we have seen in the past 1 month or so, you will typically see that the reaction on a longer end is much severe, right? But the same thing, the same basis point movement, if it only is contained with 6 months and 1 year, then the volatility is far lower.
That brings me to a very interesting part. The fund has been really consistent in performance, and yes, we understand from you that cutting average maturity and adding average maturity at the right times is what actually has helped the performance of the fund. But how are you able to do this consistently? Can you give us a peek into that?
So average maturity plays a big part of it.
Mm-hmm.
But it's not just the average maturity. There are other things like how you bucket the maturities, what positions you take at what time. So there is obviously seasonality involved in the rates. How you take in terms of the flows that you get in your fund, and so there are a lot of other things as well. Demand, supply, spreads available at that point in time, and those all contribute to your overall return.
So what are those main key 2 factors or 3 factors which help you decide which maturity bucket to go overweight or underweight on?
Spread is one thing. I think that remains a central part of spreads. Can be yield spreads can be various instrument spreads, for example NBFCs versus CDs, CDs versus Treasury Bills. Within Treasury Bills you have like whether you want to go 3 months, 6 months, 1 year. So within each of this there are decent amount of spread combinations which are available, and how you want to use them in order to keep liquidity also of the portfolio at the optimum levels, and at the same time take advantage of falling yields in a particular bucket as you.
Interesting. And what is the extent of overweight that you could go on a maturity? 3 months, 6 months, 9 months? Any?
So again,
is there a limit to it, or?
So again, it really depends. Which part of a year you are setting, that determines, which kind of month maturity you will pick up, right? So typically, if you are setting in the final quarter, it's 1 year. It's obvious, right?
True.
That you do that. But when you're coming in the month of April, for example, at that point in time, you need to kind of, ascertain how you see the spreads.
So right time to bring in the roll down question and ask you that. How do you approach the roll down strategy in this fund? Do you approach it, and which scenarios would you approach it?
So roll down can be a part of entire year or some years, or during certain rate cycle environment. It may be very optimal to have a roll down strategy, but it definitely, my experience over years is that it can work within certain time frames, but across time frames it's not. No strategy works like,
of course,
across time frames.
But would it be really a pure roll down, or it could be, but if you have a shorter cycle coming up within the longer cycle that you've anticipated, you could have roll down happening within a range, right? Is that possible?
Yeah, correct. So as I said, so for example, there are decent 3-4 months when you want to really roll down, right? And that may be a part of strategy, or maybe part of your positioning every year. So you will see those roll down. But again, as I said, it really depends on how you are viewing the market environment, whether you want to kind of increase or decrease. How do you address?
The LRAR, CRAR regulation, how does that benefit the money market space?
Regulatory environment has been evolving, and I think a good part of this growth, the fund category growth, I would ascribe to regulations. It has ensured that the funds maintain a very good amount of liquidity, a very good amount of high quality instruments, which is in line with, let's say, the liability part of it, which ensures that even if there is a volatile environment in market or in fund, the fund is able to easily navigate such instances. So thus, if we see how these categories behave, let's say 5 years ago, when these regulations were not in place versus how they are behaving now, we are seeing that the volatility is far lower in that rate. And I think thanks to this regulation. Now, how does it work? LRAR is all about keeping liquidity in a LRAR eligible instrument, which is a very high quality liquidity, which is equivalent. So now what are LRAR instruments? This is cash or sovereigns, Treasury Bill or GSEC. Now you can easily, kind of liquidate this position at a very short notice. The impact cost, as we say, the price versus if you want to execute a large quantity, the difference between what you see the market price and when you want to sell, which is called impact cost, that also is very low for this instrument. And thus, when your liability side is higher, you are required to maintain a higher LRAR ratio. Otherwise, typically, for markets in this category, the LRAR requirement would be close to like 13 to 16, 17%, which means that much of portfolio liquidity is always maintained by the fund, right? So even if it were to have a overnight kind of, requirement, this is just easily liquidable. What we have seen now this regulation also comes along with that if you are not fulfilling this requirement, the fund cannot buy anything else, which means it will have to ensure that the fund goes back to so it goes back to refurbish its ratio before it can start buying.
Great. Thank you, Amit, for taking us through the fixed income market, the factors which impact the short end of the yield curve, and Tata Money Market Fund details. Thank you so much. So happy investing in Tata Money Market Fund. This is one category which has very low volatility, relatively low volatility, because it captures CPs and CDs largely under 1 year. And this fund, creates alpha and manages the downside also by raising average maturity and reducing average maturity at opportune times. And not just this, it also, endeavors to go overweight or underweight in certain maturity buckets to create alpha. So happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.